I get asked this question all the time. Andrew, why would I invest in the infinite banking concept when I can get a higher return investing in X, Y, or Z? Well, the answer, I can take that exact same investment and show you how to double your profit with it without taking any more risk. This is not about either or. This is about and. This is about using your own banking system to fund your investments and create a deductible expense and create a higher profit return back into your pocket instead of that money going to the banks or going to the government. So I'm going to break down a case for you. Real case. Somebody asked me, Andrew, so I got $1 million. How do I invest that in the infinite banking concept, or how does this look? Because I got a guy and I can do a 9% private lending deal, and I could put that money to work and get 9% a year on that money. So let's break this down, how this works and how I explain this to one of my clients. So the first thing that we need to baseline is you can't just put $1 million into an insurance contract. There's a time, it takes time to build that capital up, but it's worth the payoff in the end, right? And you got to start sometime. And the sooner you start, once the system's in place, it's in place for the rest of your life, the rest of your kids' life, the rest of your grandkids' life. So the fastest way we can do that is, in this example, we did a joint policy with him and his wife, and $125,000 for 8 years. And then we stopped payments and wound it up. So after 8 years, then the dividends and some of the cash value start paying for the premiums. So, and what we can do is we can backdate a policy. So for the first 2 years, so he could put $250,000 in for the first 1 year, which would equal 2 years of premium payments. So the fastest we could get this $1 million working for him is in 7 years. So I broke this down on a spreadsheet here. So year one, $250,000. There's $220,000 in cash value, and he can take up to $198,000 in policy loans. So just because he put his money into the insurance contract doesn't mean it's not liquid. He could still have money working, but just to try and compare apples to apples, I'm going to show you guys how to put $1 million into a life insurance contract, and then we're going to compare several investments just with the investment and the investment with the life insurance contract with the $1 million invested at the same time, right? So this could perform better if we use this money and constantly have it invested in the market, but I just want to show you guys apples to apples exactly what it looks like. We need to control some of the variables. So that's what we're going to do. So after 7 years, he's put $1 million into the policy. There's a $1.109 million cash value, and there's $998,000 available for a policy loan. So that's what that looks like. Pretty close to the $1 million. So now let's just baseline this 9% private lending investment, right? So he takes $1 million, he's got a 9% return, so it's $90,000 a year. And taxes, this is a really important point here. So if he had zero other income, he would have to pay $18,000 in taxes. So his after-tax return is $71,000. So yeah, on the $90,000, if he had zero other income, he'd be paying 20% average tax on that. So in year one, it's 7.2%, right? Down from 9. And as the income increases, so does the tax. The taxes increase. And I figured this out exactly for each amount. And what happens is, because of our graduated tax rate in Canada, when you're making dividend income or interest income like this, it's treated just like regular income. So after 20 years having his $1 million invested, his average return is 6.47%, and he ends up paying $1 million in taxes. So out of the $1 million, now that investment account has turned into $3.1 million. So he now has a $2.1 million profit. So his after-tax take-home profit's $2.1 million on that $1 million investment after 20 years. So that's a 213% return on the money. Now, that's a little bit of a fantasy land. I just wanted to just show that, because in reality, and in this example, they do make income personally as well, $150,000 a year. So that means instead of a 20% tax rate, average tax rate on that $90,000, now it goes up to a 34% average tax rate, and that number increases as the income increases as well. So the realistic number is a 5.87% return on the first year. And if we follow that down for 20 years, it's a 5.5% average return after 20 years. So it's very interesting. A 9% pre-tax return is the same as a 5.5% after-tax return, which is almost exact same as what a life insurance policy compounds at. So in this taxable, with the extra income example, he pays $1.2 million in tax, and the investment account is at $2.7 million. So he's made $1.797 million in profit on the million. So that's his after-tax take-home profit, $1,797,671. So that's 179% return. So you can see the difference just in the taxes. You know, with if you're making no other income and that's the only income source, it's a 213% return. And with making $150,000 a year and then also making this income, it goes down to 179% return. So that's our baseline we're going to be working with here. So now let's take a look at using that policy to invest in that same investment. So we got a $1.1 million cash value. They take $1 million policy loan. There's $65,000 in policy loan interest, which means, and this is the magic of these policies, this is the best use of these policies in Canada, is taking policy loans to purchase income generating assets. And that wording is key, because that allows us to unlock a part of the Income Tax Act that allows us to create deductions, right, from that income, from those income generating assets, which means we lower our tax liability, which means we increase our returns. So this is how this works in this example. So there's a $65,000 policy loan interest, which means of that $90,000, there's only $25,000 of taxable income on that. So he only pays $7,600 in taxes. And the net return is 8.23%, so $82,000. So if we compare that to the last example, they pay $31,000 in taxes on the $90,000, or they pay $7,600 in taxes. It creates a significant tax advantage when we're operating our investments through our own banking system like this. So let's take a look. So it starts at 8.3, and it does go down because of the graduated tax rate in Canada. And in this example, we just left the investment account at the million, and then we just take the interest, pay down the policy loans, and put the rest of the money back into the policy. So let's see how this works. So after 20 years, they average a 7.97% return over 20 years. They only pay $230,000 in tax total, whereas in the other example, they paid $1.2 million in tax. So it's $1 million in tax savings, right? That doesn't go to the government, that we get to recapture. And what happens is the policy cash value, that compounds at about 5.5% tax-free. So the cash value on that million after 20 years is $2.9 million. And we were paying honest banker here and paying down the policy loan with that income, creating that deductible expense and lowering our taxable income, and then using the income from that asset and paying down our policy loans. So after 20 years, we have $542,000 still outstanding on the policy loan, and we have a $2.9 million cash value. So the profit is $2.36 million. So that's on top of the $1 million that we invested. Now we have an additional $2.367 million. When we minus the policy cash value, the policy loan from the policy cash value, we're left with $2.367 million cash. And there's also a $700,000 death benefit attached to that policy if something happens. We're going to pretend at this example that, after 20 years, the person passes away and, the estate's going to need to get settled. So at the end of the day, using the same investment, just flowing the money a different way, the after-tax take-home profit is $3,067,000. So that's a 306% return instead of 179% return. How good is that? Now, I think we can do a little bit better. If we look at another example, the same investment, but we're just going to flow the money a little bit differently. So we do, there's $1.1 million in the policy cash value. We take a $1 million policy loan. We still have the same $65,000 in policy loan interest. But what we're going to do with this example is we're going to keep the policy loan at $1 million. So we're going to pay the $65,000 a year in policy loan interest. And then the remainder, instead of paying down the policy loan, we're going to put it back into the private lending investment. And we're going to grow that account more. So year one, very similar, 8.23%. And if we go down after 20 years, so we end up with a 7.84% return average over 20 years. We pay $277,000 in taxes total. And we have a $1 million policy loan, a $2.9 million policy cash value, and a $1.5 million investment account. So let's break that down again. So the profit on the investment, so that's gone up $531,000 on top of the $1 million. That's the profit. The policy, there's $1.9 million in cash value. If we minus the $2.9 million from the $1 million policy loan, there's $1.9 million cash available, plus the $700,000 death benefit. So the after-tax take-home profit on that investment is $3,141,388. So that's a 314% return instead of a 306% or a 179%. But I think we can do better. And this is the most efficient way to operate one of these policies, is to keep that capital that's in your policy working as hard as it can. And it's safe sitting in your policy, it's protected. But if your goal, which is what a lot of people say, I can get a higher return doing this or that. So if our goal is to get a higher return, then putting that money to work in two places at once for as long as we can is the fastest way to get there. So in this example, $1 million policy loan, we invest into the policy. We have our $65,000 policy loan interest. So with the policy loans, the cash value, the $1.1 million, you can take 90% of the cash value. So if we want to maximize our returns using these policies, we max out our policy loan limit, which is 90% of our cash value, and we purchase income generating assets. And that allows us to create the deductible expense, so we lower our tax burden on that income that's generated. We flow it back into the policy, and then we flow it back into another investment, right? And just keep that workhorse engine rolling. So in this example, that's exactly what we do. We maximize our policy loans, and then we cycle the money back into the policy and then back into the income generating asset to create more income. So after 20 years on this example, we end up with a 7.93% return. We end up paying $428,000 in taxes. We've maxed out our policy loans versus our cash value. And we've also grown the investment account quite aggressively. So if we break this down, the profit on the investment account, we started with $1 million. Now there's $2.414 million in profit. So the investment account's at $3.4 million. So there's $2.4 million in profit. There's $290,000 in cash value in the policy. So the 209,000 minus the 2.9 million minus the 2.6 million leaves us 290,000. And then there's still the additional $700,000 death benefit at that time. So the after-tax take-home profit, maximizing our system, is $3.4 million, which is a 340% return. So I don't know about you, but the next time somebody asks me, but I can get a higher return with, private lending, or I can get a higher return with real estate. I always say, well, if I can show you how to double that return that you're getting right now without spending any extra money using the exact same dollar amount, is that something you'd be interested in? Because my goal is to help people buy time, to reach their goals faster. And I believe this is the best vehicle to do that. So let's take a look at another example, real estate. So in this example here, we have $1 million property purchase. They pay cash. And in BC, there's, over the last 100 years, the appreciation, so the value of the houses and real estate have gone up about 4% a year, average, for the last 100 years. So we're going to use a 4% growth rate on the price of the property. And I've looked it up the last 25 years. The cap rate average is about 6%. So that's the income that gets generated from the property by renting it out. And that's pre-tax income. The cap rate is calculated. So continuing on with this same example, so that's $60,000 taxable income. So that's $20,000 in taxes that's payable on that. So the net return on the cash flow is actually 3.92% instead of 6%. So if we continue down, the property value keeps increasing, the cap rate stays around 6%. So if we continue on with this investment for 20 years, the average return is 5.71%. The net return is $1 million in cash that they'll, after tax cash, put into their pockets. And they'll pay $575,000 in taxes over that time. And at 4%, the growth rate, the property will go from $1 million to $2,025,000. So the profit on the property is $1,025,000 profit on top of the initial investment. And then there's capital gains on that. So when they sell that property, the person dies, or they sell that property, they'll owe $256,000 on that property. So we got to minus that from the profit. And they made $1 million in cash, and that's after-tax cash in their pocket. So their total after-tax take-home profit after 20 years is $1.854 million. So they made 185% return on their $1 million in 20 years. And this is a pretty standard classic real estate example here. It's average. It's very common, these kind of numbers. So let's take a look at what happened if you purchase that property using a policy loan instead, right? So same thing, $1.11 million cash value. We take out $1 million policy loan. We purchase the property, 6% cap rate. An interesting thing happens the first couple years. So there's a $65,000 policy loan interest expense that we can reduce our taxable income with. Well, the income from the property pre-tax is only $60,000, which means we can deduct $65,000. So he actually can deduct $5,000 of additional taxable income from his other sources of income. So he actually ends up paying $1,500 less in taxes than before he had this investment. It's actually like lowering his tax burden on his personal side as well, because he purchased an income generating asset with the policy loan. And this unlocks the door to a bunch of different things in the income tax for us that we can take advantage of for our benefit. So his net return is actually $61,500 on his original $60,000 in income. So he doesn't pay any tax on that income. He lowers his other tax burden, and he ends up with a 6.16% return on his money in year one. And let's just continue on. Let's have a look at what happens after 20 years. So on average, he's made a 7.79% return on his cash flow portion of the money on that property. He's paid $180,000 in taxes only, compared to the $575,000 in taxes in the other example. And the policy loan, he's used that cash just to knock down and keep paying down the policy loan. So at the end of the day, after 20 years, he still has $512,000 outstanding. And he also has $2.9 million cash value. So if we break down these numbers here, and the property is also worth $2 million. So if we break down this number, the profit on the property is $1,025,000. And then we minus our capital gains, the $256,000. There's still the capital gains component. But the policy has a $2.397 million available cash value. Plus, there's still the $700,000 death benefit. So the after-tax take-home profit is $3.8 million. So that's a 386% return using the exact same money during the exact same time, just flowing and controlling the money that benefits you instead of the government and instead of the banks. So it's, I don't know about you, but would you rather have 185% return over 20 years? Or would you rather have a 386% return over 5 years? I totally agree. There is places where you can get a higher profit than life insurance contract. But there's no way you can get a higher return than using a life insurance contract and that investment, right? So I hope you guys learned something here. I'd love to show you other investments. I'd love to show you how this works. Book a call with me. Let's go over your numbers. Let's come up with a strategy that works for you, for your family. And my goal is to help you achieve your goals faster. I want to help you buy time to help you live the life that you want to live. Not doing the things you don't want to do because you have to or you feel like you have to. Life's meant to be lived. So I'd love to be your partner and work together and help you achieve that goal. See you soon.